I'd say the short answer to your question is probably not a lot. Certainly, LPs took a moment to pause and to reflect on their allocations for the year, also keeping a close eye on what public markets were doing in reaction to the COVID crisis. And naturally, I think there was some pause to reflect when in March the public markets did react. But if you remember, they also snapped back quite quickly. And so LPs didn't, or at least seemingly, haven't felt the need to make too many changes to their programs. I think the other important lesson was the one learned from the GFC back in 2008, 2009, where a lot of LPs did pause and halt programs. And in kind of looking back at what they did back then, that probably wasn't the right decision. And so from that perspective, I think there were also lessons learned from that period. What naturally also helped is that Q2 valuations in the private equity portfolio bounced back quite nicely, and also into Q3. And so I think on the whole, LPs really have stuck with their program and supported in particular their existing managers when they were doing re-ups. I think on the whole, in the short term, the asset class and the demand for the asset class has been really stable. And in the long term, I suspect, and I'm optimistic, that we'll actually see quite a bit of continued growth in the asset class. It's maybe too early to predict the next 6 to 12 months, but if you look 2 to 5 years out, I'm pretty confident in that statement. There's also naturally some good market data out there. A recent survey by Preqin released suggests that the asset class private equity will double, more than double, from $4.4 trillion at the end of 2020 to more than $9 trillion by the end of 2025. And obviously those are huge growth numbers forecast there. We similarly posed a question to our super investor audience earlier this week. And here, about 67% of respondents said that they would expect allocations to the asset class to increase next year. So that's 2021, with I think only 11% saying that they would expect them to decrease. So overall, really positive signs for the momentum here. I think there's several factors at play here, in particular around, obviously, LPs hunting for yield, and with the low interest rate levels around the world. There's a proven performance post the great financial crisis, which CIOs can now look back onto. And then last but certainly not least, I think the governance model of private equity is really strong. And so both both private companies who wish to remain private are interested in working together with private equity, and also certain public companies might prefer to go through certain value creation plans outside of the public eye and do that under private ownership. And there the governance model has proven strong. And so teaming up here might make sense for some public companies as well. So overall, I think there's more to grow. And if you keep in mind that public markets, I think, have a size of 90 trillion plus currently, relative to private equity, there's still a bit of growth left. I think that's probably a bit too early to tell. I think on the LPs on the whole will admit that they've focused mainly on re-ups in 2020, and the pipeline for re-ups in the market actually was pretty full. A lot of the processes had already been underway pre-COVID, but I also know of some 100% virtual fundraisers, and LPs have been able to adapt to that world as well. So LPs do find underwriting brand new fund commitments with new relationships, I think, a bit trickier to do that without having met them prior. And some LPs will probably have to adapt internal policies next year if they do want to commit to some of those funds that might be in their pipeline. So, but LPs have shown flexibility, and I think they will continue to adopt to the situation that sort of COVID throws upon all of us, to ensure that they maintain a steady investment pace in line with their internal policies. I think what we've seen, maybe not dislocation, but we've definitely seen certain trends around sectors. I think technology and healthcare continue to be seen as very resilient sectors. And so where sector funds and sector specialist funds are probably more prevalent in North America. I think we've seen continue to see a lot of inbound interest into those strategies, and that obviously includes not just our programs but also our friendly competitors. I think equally on the topic of co-invest, the focus is very much on that business resiliency and how those businesses have performed under COVID, and so that's naturally a pretty good stress test as LPs look at certain co-investment opportunities. I think the pandemic will allow LPs to get a better insight into the operational capabilities of their GPs. And that might be harder, or that has been, I think, frankly, harder in an environment where we've seen continued growth since the great financial crisis. This is a bit of a tougher playing field now, and maybe it does allow LPs to get a better insight into how their GPs are really working on an operational basis with their portfolio companies. That might lead to LPs making some longer term decisions or changes in their portfolio allocation, and they might continue to back certain GPs over other GPs as a result of the lessons or insights they've gained from seeing their GPs work under COVID. I'd say there was definitely an immediate information sort of thirst and requirement around the impact of COVID or potential impact of COVID on the portfolio. I'd say in particular around the topic of liquidity. So would the GP need to support their portfolio companies? How is the debt trading? Are there potential covenant issues? I think as a whole, the industry, and I've heard that from many LPs, the GP community has actually done a really good job in responding to that information request. And frankly, that's from lessons learned, again, back from 2008, where maybe GPs were a bit slower off the blocks in being in communicating with their LPs. So on the whole, I think LPs have been pleased with the depth and the kind of amount of and regularity of communication with the LPs. And I would also say on the flip side, LPs are probably much better positioned internally to report back up to their CIOs what their exposure is to certain subsectors, because LPs have over the years improved their own internal reporting and tracking of underlying company exposure and sector exposure that they can then report internally on up to their CIO. So as a whole, I would say that piece was maybe unexpected, but it was good to see that the GP community sort of ticked the box in terms of reporting. I think as a result of all of that, but also as a result of the nature of the crisis, LPs do put a higher emphasis sort of on the overall quality of governance and the quality of decision making within a firm, because I think they realize that that's pretty important right now. And so maybe there have been a few more questions around that. How has the GP coped? What's the communication with portfolio companies been like? How is the GP handling remote working, and how are they managing their staff? I also think, frankly, that some LPs do look to their GP relationships a little bit also for sharing of best practices. How have we worked with our colleagues in a remote setting? Are there best practices around town hall communication, internal use of platforms like Slack, team building ideas? So I think from that perspective, there's been a good open dialogue also on some of those softer topics. I think there will definitely be more focus on topics like ESG that will then also in turn lead to more dedicated strategies targeting that demand. That could, for example, be in the shape of impact funds. This year, ESG has really resonated around the world. If there's, one of the very few positives of this crisis is really that the focus on ESG hasn't gone away, quite on the contrary, and that's not just across private equity, but across all of the asset classes. It's part of every conversation we're having these days with our investors, and I suspect that that trend won't go away. So I think the focus on ESG, that's going to get magnified, then also by just the continued desire by LPs to build ever closer relationships with their GPs. That will also come through in the topic of co-invest, which is increasingly important for investors. And so they will try to build ever deeper relationships with their GPs also on that topic. As we think about broader appetites for LPs, we talked a bit about the sort of the impact theme. We talked about co-invest. There might be, other strategies that an LP wants to pursue, and I suspect that they see the value of entering new strategies, maybe alongside their existing GP relationships. There's obviously more and more GPs out there that themselves have, tried to build out the strategies that they manage, and LPs will probably trust their closest GP relationships in trialing out some of those early strategies and investing alongside their trusted GP relationships. I think finally, when it comes to sort of the classic private equity piece and where to find a value and where to entrust money with a GP, there's an argument to be made that in a high price environment, which we're still in, that some of those strategies where GPs are sort of doing the same strategy, the same playbook over and over will resonate with LPs, because there's a proven model and there's a proven model of value creation, which can work even in a more higher priced environment. And so I think we are going to see this continued evolution of thematic styles where you can underwrite, the point from A to B very well, and where the GP can make that point to their investors that they can be trusted with their capital. So I think that's maybe one of the other themes we're going to see in the coming years.